Hi, welcome to Elements in Focus. Today we're talking about tax efficient estate planning strategies. Today I have Daren Hardesty, our certified financial planner in our Anderson office, here with me. How are you, Daren?
Doing good, Aaron. How about yourself?
I am wonderful. It's a nice sunny day here in Indiana as we're recording this. If you're new to Elements in Focus, this is where one of the advisors and myself on our team cover one of our five critical elements. And today, as I mentioned, we're talking about legacy planning, especially talking about tax efficient wealth transfer today. So, Daren, why don't we get into the topic? Let's turn it over to you and get into the topic of tax efficient wealth transfer.
I love it. Yeah, thank you, Aaron, for the introduction. And as most people, if you are watching these regularly, you know that you hear me talking a lot on the estate planning and legacy planning side. FEG, we love to make sure that we're helping our families control what they can control. Unfortunately, we can't control the market, but we can obviously diversify and be tactical with our investments and have some control. But we can't really, there's not a set of rules that say, hey, if you do this, you are establishing something that you know is going to happen in the future. It's one reason I really love estate planning as a part of being a financial planner. You really get to help families understand how assets flow, what they should be aware of, things they can consider, things that go into documents or maybe just beneficiary designations. However, complex or simple your estate is, there's ways that you can make sure that your estate plan is in good order. And when it comes to taxes, most people, I would say, have some sort of form of fear of what they don't know. Where a lot of people feel like when they inherit something, one of the first questions I get, I actually just took a call this morning from one of our families who had lost their father, receiving an inheritance. The very first question they asked was, "What does this mean for my taxes?" And that answer is variable, like most things in our industry. It's all based off of the types of assets that you inherit. One thing that I can do for the vast majority of people watching this is that you don't have to worry about there being any type of estate tax or inheritance tax. Estate taxes for on the federal side, the state side is a little bit different, so I'm going to kind of dive into that. On the federal side, under today's rules, you and your spouse need to have somewhere in the ballpark of $30 million before any estate tax on the federal government is applied. So that estate tax, however you feel about it, most of us just don't have to worry about it. Now, some of you watching may have lived in a time period where a lot of people that we take care of here at FEG did have an estate tax issue. Just because the amount of money that you had in your estate, it used to be much lower for you to actually apply or qualify to receive estate taxes. So there was a lot of planning. If you've been in this game, or if you've had an advisor or been focusing on this for the last 20 plus years, there was probably a time where it was true that you had an estate tax issue. Today, just most of us don't. And if you have over 30 million in your estate, there is a lot of complexity, taxes included, that you need to be aware of. And for those people that are in that situation, we can definitely talk to you and be more in depth. So I'm going to focus more on the general public, the people that have, somewhere in the ballpark of $500,000 to $3 million in their estate. Still a great nest egg. What I can tell you is that in Indiana, we don't have an inheritance tax. So there's no federal tax, estate tax you have to worry about. In Indiana, there's also no state tax you have to worry about. It's only currently 5 states that still have an inheritance tax. So if you're wondering if you're one of those 5 states, that's something that you can obviously look into. Those rates, vary depending on the state. But in Indiana and the vast majority of our country, most of 45 other states, we don't have an inheritance tax. So when you receive an inheritance, don't think about it as, hey, am I going to have to worry about taxes? Because probably 99% of the time, you don't have to worry about it. So what you do need to consider is the type of accounts or assets that you're receiving. If you have or inheriting anything that has what's called an unrealized capital gain, meaning that you've bought a property, you invested in a brokerage account of some kind, not an IRA or a Roth IRA, but something that's a non qualified brokerage account, anything where you have been accumulating growth on the initial investment that you purchased. Um, while the owner of that account or of those assets is alive, they have a tax issue only if they choose to sell. While they're living, they're accumulating those gains. And so that, if they were to sell because they were the one that bought it, they would have to pay potentially some capital gains tax on those assets. The way the current structure of the tax code is set up is that if that person dies with those assets, all of the unrealized gains and growth on top of the investment becomes tax free at the date of death. It's called a step up in cost basis. So the family I just spoke to this morning, one of the parts of their inheritance had a large amount of stock that was unrealized, had a lot of unrealized capital gains that her dad had a lot of gains that he would have to pay tax. On the date of his passing, there's a full step up on all that growth, meaning that she gets to receive those stocks from that account, essentially almost tax free. Any growth that she would owe tax on if she was to sell is from the date of death until the time that she makes the sale. So typically, when you receive assets like that, it's generally a tax efficient or almost tax free inheritance. Same thing if you inherit a home that has unrealized gains, if you inherit rental properties, farm ground, anything that has accumulated in value from the date of the purchase, you're going to see that step up take place. So it takes a little bit of time to make sure that that's all worked out. But when you receive it, sleep free, that you don't have to worry about having to make a big or write a big check to the IRS because of that. The thing that has the most tax inefficiency is inheriting qualified accounts. So particularly IRAs, 401ks, traditional, not Roth. If you're a non-spouse beneficiary, you have an income tax that you're inheriting. And all that means is that when you receive that account, you've got 10 years from the time that you inherit it to remove all of that money from that account. So in this case, let's say if it's 150,000, well, you've got essentially 10 years to remove 150,000 from that account. And as that money leaves that inherited IRA, you pay income tax on that account. You don't pay an inheritance tax or an estate tax. It is based off your income. So there's ways that we can get ahead of that. When we're looking at tax efficient transfers, there's not much you can do at the time of the account owner's passing, but leading up to that, we can make sure that, hey, if there's Roth conversions that you can do that are more tax efficient, we do a lot of that with our families. That, hey, if you can do this Roth conversion at a 12% marginal tax rate, rather than your kids inheriting the money when they're in their high income earning years and having to take that money out at a 24 or higher percent tax rate, well, then it makes sense. The IRS is getting less from the current account owner by doing those conversions. And there's little things you can do to chunk money out to make sure that you're leaving something behind that your kids receive where they don't have a big tax burden. But really, when you think about wealth transfer and tax efficiency, it's stuff that you have to do as much as you can on the front end to benefit your kids on the back end. And really, it's variable. It just depends on the account sizes. It depends on what your kids do. It depends on all the different parts of your estate that come into play. And that's where we come in. We're able to dive in with you, personalize it, take a look through, start talking through, hey, here's what to consider, here's things that we can do. And for most of our families at FEG, we're pretty confident that we're really, truly trying to help complete that financial journey. Whether it's through the investments, the estate plan, the tax planning, everything that we do, we're considering that individually, family by family, to make sure that we're considering these things and getting ahead of it if we do see an issue on the horizon. So the big message today, Aaron, is that most people don't worry about an estate tax. If you have a large estate and you have questions, we want to talk to you. We want to make sure that we get you with the right people, with our team and others to get you set up, because there's a lot more complexity there. But for most of us walking around that are just accumulating and have done a good job and have a nice nest egg, typically it's going to be pretty efficient on the transfer side. So I went off on a tangent. I love these things, Aaron, because I can't talk about this stuff with my friends. They just think I'm boring when I talk about this stuff. So I love having a chance to talk with families that want to know more about this. So, I love if you have questions, reach out. That's why we're here. We want to make sure that we're guiding you along this path and helping you consider all these things that you may only do once in your life, but we do this on a daily basis here at FEG.
If you want more information, or you want just a review of where you're at along your life after work, or even if you're looking for a different guide to make sure that your financial journey is going down the right path, FEG is here for you. Give us a call, 800-928-4001. You can request a complimentary next steps meeting at yourlifeafterwork.com. There's a contact us section. You can fill that in. One of the advisors on our team will give you a call, reach out, ask you a few questions. to make sure that we have a good understanding of what you're wanting to accomplish in that next steps meeting. During that next steps meeting, it's a 90-minute meeting where we'll consult with you and we'll have a collaborative talk about your situation, your specific situation. We'll give you things to think about today, things to think about in the future, and if we decide to partner together, a written plan for what FEG will do for you and your family. Thank you so much for watching. We really appreciate the work we can do for our current families and absolutely appreciate any future families that we can take care of. Have a blessed day, and thank you so much again for watching.